Warriors of price action and guardians of fundamentals, welcome to Retail Recon. In our previous chart basics episode, we looked at individual candlesticks, how the market matches buyers and sellers, and we addressed support and resistance, those battlefield lines where the players step in to stop the advances. But if you only look at a raw price chart, you know it can look like pure chaos. Red and green flashes everywhere, spikes up and down, total noise. Today's mission is to introduce the most effective tool for cutting through that noise, the moving average. We aren't just looking at math today. We are looking at how to identify the true direction of the trend so you stop fighting the current and start swimming with it. By the end of this episode, you'll understand the difference between simple and exponential averages, why the big institutions respect specific numbers, and how to tell at a glance if the bulls or bears are really in charge. So gear up and let's go to work. What is a moving average? Imagine you are tracking the temperature over 10 days. One day it's 5 degrees, the next it's 12, then it drops to 4. If you just look at the daily spikes, it's hard to see the season changing. But if you take the average of those 10 days, you get a smooth line that shows you the real trend. A moving average does exactly this with price. It takes the closing prices of a set number of candles, let's say the last 20 days, adds them up and divides by 20. As a new day begins, the oldest day drops off the calculation and the newest day is added. This makes the average move along with the price. On your screen you see a naked chart of Microsoft, just candles. It looks choppy. Now look at the same chart when I add 22 and 150 day period line. Suddenly the chaos disappears. You can see a clear, smooth path. Those lines are the mean or the equilibrium. It tells you the story that the individual candles are trying to hide. There are two main types of moving averages you need to know. The simple moving average, SMA, and the exponential moving average, EMA. This is where beginners often get confused, but the difference is actually very tactical. The simple moving average treats every day in the look-back period as equal. If you are using a 50-day SMA, the price from 49 days ago has the exact same weight as the price from yesterday. It is slow, it is stable, and it is great for long-term trends. The exponential moving average, EMA, is different. It uses a mathematical formula to give more weight or importance to the most recent price data. Think of it like this. If you are a scout on the battlefield, do you care more about where the enemy was a month ago or where they were 10 minutes ago? The EMA reacts faster to sudden price changes. Which one should you use? Use the SMA for major long-term levels that the whole world is watching. Use the EMA if you want to see short-term shifts in momentum faster. In my personal rules of engagement, I lean toward the EMA because in the modern, high-speed market, recent data is usually more relevant. In trading, some numbers matter more than others because everyone is watching them. Moving averages are a self-fulfilling prophecy. If a billion-dollar hedge fund algorithm is programmed to buy when the price hits the 200-day average, then the price will likely bounce there. Here are the 3 mission-critical lengths you need on your charts. The 20-day period, the tactical line. This tracks short-term momentum. In a strong trend, the price will often ride right on top of this line. The 50 period, the trend guard. This is the mid-term trend indicator. This is where most institutional dip buyers step in. The 200 period, the battlefield boundary. This is the king. It separates a bull market from a bear market. If a stock is below its 200-day average, it is in the basement and you should be very careful about buying. Personally, while I track these, when I trade, I set up my trades based on 22 and 150-day exponential moving averages. No special magic here. I just find them to be more in line with my trading style. How do you use these lines to plan your decisions? I use a simple system. Above. Price is above the 50 and the 200. The trend is up. You should primarily look for long trades. Don't be scared if you don't catch the exact moment the price jumps. If you think I missed it, remember, a month later it might reach even higher highs. Just keep your exit plan in place. Closed. Price is between the 50 and the 200. The market is in a transition or no man's land. This is where chop happens. It's usually better for quick setups and smaller gains. Below. Price is below the 200. The primary trend is down. Unless you are looking for a short, trying to buy here is like trying to catch a falling knife. A quick word on the below zone. Above the line, we buy. Below the line, we protect capital or go short. If you're a beginner and don't understand margin requirements or how shorts work, stay away from those trades for now. Using inverse ETFs, buying puts or selling calls can express a short view with defined risk, but be careful. Inverse ETFs are expensive and intended for short-term holding. And of course, remember, the moving average is a lagging indicator. It tells you what has happened, but it acts as a psychological barrier for the price. Before you go and slap 20 lines on your chart, here are a couple of common mistakes. Mistake 1, the spaghetti chart. Beginners often add the 10, 20, 30, 50, 100 and 200 all at once. You get analysis paralysis. Keep it simple. I use the 22 and 150 EMA for my setups. Mistake 2, expecting a wall. A moving average is not a brick wall, it is a zone. Price will often pierce the line slightly before bouncing. Don't set your stops exactly on the line or the market makers will hunt them. Mistake 3, flat lines. Moving averages work best in trending markets. If the market is moving sideways, the moving average will go flat and price will whipsaw back and forth. I don't use them in sideways markets. To recap, moving averages smooth out the noise of the battlefield. They show you the true trend and help you identify institutional value zones. Now that you know what they are, you're ready for the tactical application. In our next mission, we'll move into target acquisition. I will show you specific trade setups using these lines, including the golden cross and the EMA bounce, so you can turn these lines into profit. If this briefing helped you clear the fog from your charts, lock in your support by liking, subscribing, and following our movement. Thanks for standing watch with me today, and until next time, trade smart, risk sharp, and stay on target.